Most people think markets panic because of bad news. They don't. Bad news is visible, it spreads fast, everyone talks about it. And once everyone is talking about something, the market has usually already adjusted. What markets actually react to is the quiet shift happening underneath the headlines, the part most people haven't noticed yet. This week is a good example. If you scroll through social media, you'll see the same narrative repeated over and over. Crypto volatility, geopolitical tensions, regulatory debates, institutional hesitation. On the surface, it looks like uncertainty. But the interesting thing about markets is that they rarely move because of what's obvious. They move because of structural changes happening behind the scenes. Changes that don't look dramatic in the moment, but quietly alter how money flows through the system. Something like that may have happened today. Not a price spike, not a sudden crash, not even a major announcement that dominated mainstream news. Instead, it was a regulatory development involving a crypto firm gaining a specific type of access to the Federal Reserve's payment infrastructure. A technical detail, really. Easy to overlook if you're only watching price charts. But details like that sometimes matter more than headlines. Because when the plumbing of the financial system starts to shift, even slightly, it can change who participates in the market, how quickly money moves, and who controls the rails that capital travels on. And that's where things start to get interesting. Over the past few days, several developments have taken place across the digital asset industry. Most of them received limited attention outside financial media, but together they mark a noticeable shift in the structure of the market. First, Kraken, a US-based cryptocurrency exchange, received approval for a skinny master account connected to the payment infrastructure of the Federal Reserve System. This type of account allows certain non-bank financial institutions to directly clear and settle their own payment transactions through core Federal Reserve rails. The access is limited in scope. A skinny master account does not grant the full privileges of a traditional banking master account. The institution holding it cannot access the Federal Reserve's discount window, cannot earn interest on balances, and cannot provide settlement services on behalf of other institutions. In practical terms, it allows the firm to process and settle its own transactions directly through systems such as FedNow, FedWire, and the National Settlement Service. Second, industry reporting indicates that Ripple submitted an application earlier in 2025 for a Federal Reserve master account. According to market coverage, the company is currently awaiting a decision. At the time of this writing, no approval has been confirmed. Third, investment activity tied to digital asset exchange traded products has continued to expand. Data shared by Bitwise Asset Management shows that its Bitwise XRP ETF has recently recorded inflows of approximately $10 million during the current trading week. Separately, new infrastructure experiments are emerging around the XRP ledger. One project, C-Link Finance, is testing a system designed to support maritime trade finance workflows using blockchain settlement rails. Finally, policy discussions in Washington continue to evolve. Executives from Coinbase, including CEO Brian Armstrong, reportedly visited the White House during ongoing debates around digital asset legislation, including proposals related to the Clarity Act. Taken individually, each of these developments is relatively contained. Taken together, they reflect gradual changes in regulation, infrastructure, and institutional participation within the digital asset market. At first glance, the developments described earlier may appear technical. A specialized Federal Reserve account, a pending application from a blockchain company, incremental inflows into a niche exchange-traded product. None of these events, on their own, would normally trigger a major market reaction. But markets rarely respond to isolated headlines. They respond to structural shifts in infrastructure. The approval granted to Kraken is a useful example. By receiving a limited master account connected to the Federal Reserve System, the firm gains the ability to clear and settle its own payments directly through Federal Reserve rails such as FedNow and FedWire. The immediate impact is operational rather than speculative. Direct settlement reduces reliance on intermediary banks. Payment flows can move through fewer layers of the financial system. In traditional finance, fewer intermediaries typically mean lower friction, faster settlement, and clearer counterparty responsibility. However, the second-order effects are potentially more significant. When a non-bank financial institution gains even limited access to central bank payment infrastructure, it signals that regulators are willing to experiment with new institutional structures. This does not mean full integration between digital asset firms and the traditional banking system is imminent, but it does suggest the regulatory boundary between the two systems may be evolving. That is where the relevance of Ripple enters the discussion. Reporting indicates that Ripple has submitted its own application for a Federal Reserve master account. If approved, such access could allow the company to settle certain payment flows directly rather than routing them through partner banks. The difference may appear subtle, but it changes the architecture of financial connectivity. Currently, many blockchain-based payment networks operate adjacent to the banking system. Banks hold the settlement accounts. Blockchain networks act as messaging or liquidity layers connected to those banks. Direct central bank access would move a firm from the outer edge of that structure to a position closer to the core infrastructure. Institutional capital tends to follow infrastructure stability. That is one reason developments around regulated investment vehicles, such as the Bitwise XRP ETF, receive attention. According to Bitwise Asset Management, recent inflows into the fund reached approximately $10 million during the current week. In isolation, that amount is modest compared to traditional equity or bond markets. But exchange-traded products often function as access points for institutional investors who cannot easily purchase underlying digital assets directly. Finally, experimental infrastructure projects using the XRP ledger, including maritime trade finance platforms such as Sea-Link Finance, highlight another potential chain reaction. The expansion of blockchain settlement beyond purely financial trading and into operational industries like logistics and global trade. In other words, the developments described earlier are less about price movements today and more about who will control the rails through which financial transactions move in the future. Financial markets rarely move in straight lines. When something appears new, it is often a variation of a structural shift that has happened before, just under different circumstances. To understand the significance of recent developments involving firms like Kraken and infrastructure tied to the Federal Reserve System, it helps to look back at how financial access has historically evolved. For decades, direct connectivity to central bank payment systems was restricted almost entirely to regulated commercial banks. Institutions that held accounts at the Federal Reserve effectively sat at the center of the financial settlement network. Other financial firms, brokerages, payment companies, clearinghouses, typically operated through those banks rather than connecting directly to the system. That structure began to shift gradually in the early 2000s as financial technology firms expanded. Payment companies such as PayPal and later Square built large transaction networks outside the traditional banking model. Initially, these firms still relied on banks for settlement. But over time, regulators began exploring frameworks that would allow certain non-bank financial institutions to interact more directly with payment infrastructure. The launch of FedNow in 2023 was part of that broader modernization effort. The system was designed to support instant payments across the United States and open the door to a wider range of financial participants, though still within carefully defined regulatory limits. Digital asset companies are now entering that same regulatory conversation. The reported application by Ripple for a Federal Reserve master account represents another step in that progression. If granted, the arrangement would resemble earlier transitions in financial infrastructure where new categories of firms gradually gained access to systems that were once exclusive to banks. However, the environment today differs in several ways. First, blockchain-based settlement introduces a parallel transaction layer that did not exist during earlier Fintech expansions. Networks such as the XRP ledger allow transactions to be validated and recorded independently of traditional banking ledgers. Second, the regulatory landscape remains unsettled. Policymakers in the United States continue debating market structure legislation such as the Clarity Act, which aims to define the legal framework governing digital assets. History offers perspective, but it does not provide exact templates. Financial infrastructure evolves gradually, often through small regulatory adjustments rather than sudden transformation. What we may be observing today could represent another incremental step in that long process. similar in direction to past changes, but unfolding in a very different technological environment. Financial markets rarely move according to a single narrative. Multiple outcomes are always possible, and the direction that ultimately unfolds usually depends on a sequence of conditions rather than one isolated event. With recent developments involving Kraken, the potential application from Ripple, and the continued expansion of digital asset investment vehicles such as the Bitwise XRP ETF, it is helpful to think about the market through scenarios rather than conclusions. Below are three possible paths the market could take depending on how regulation, liquidity, and institutional adoption evolve. Bull case, infrastructure expansion accelerates. For the stronger scenario to develop, several conditions would likely need to align. First, regulators would need to continue expanding access to core financial infrastructure. The approval granted to Kraken for limited Federal Reserve settlement access could serve as an early precedent. If additional firms receive similar permissions, or if companies such as Ripple eventually gain some form of master account connectivity to the Federal Reserve System, the operational barriers between traditional finance and digital asset infrastructure would narrow. Second, regulatory clarity would need to improve. Passage of legislation such as the Clarity Act could define how digital assets are classified and supervised in the United States. Clear regulatory frameworks often encourage institutional participation because large financial firms typically require defined compliance standards before allocating capital. Third, institutional investment channels would need to expand. Products like the Bitwise X RPETF demonstrate how exchange-traded structures can provide traditional investors with regulated exposure to digital assets. If flows into these vehicles increase steadily, they could gradually deepen liquidity across the broader crypto market. Under these conditions, blockchain settlement networks such as the XRP ledger could see broader integration into financial and commercial infrastructure. Base case: gradual integration continues. A more neutral scenario assumes that recent developments represent incremental progress rather than a rapid transformation. In this case, additional fintech or digital asset firms might gain limited access to payment infrastructure over time, but the core structure of the banking system would remain largely unchanged. Digital asset firms would continue to operate alongside traditional banks rather than replacing them. Regulation would likely advance slowly through a combination of legislation, agency guidance, and court decisions. This gradual process could produce occasional periods of uncertainty, but the general trend would still move toward clearer frameworks. Investment products, such as exchange-traded funds, would continue to expand gradually as regulators evaluate new applications and as market demand develops. Institutional capital might enter the market in phases rather than in large, immediate waves. Under this scenario, blockchain-based financial infrastructure would continue developing in specific use cases: cross-border settlement, trade finance, tokenized assets, without immediately replacing existing systems. Bear case: structural friction slows adoption. The weaker scenario would involve a combination of regulatory delays, macroeconomic pressure, and limited institutional adoption. If legislative proposals like the Clarity Act stall or face prolonged debate, uncertainty could persist around the legal status of digital assets in the United States. Large financial institutions often delay strategic investments in sectors where regulatory frameworks remain unresolved. In addition, tighter monetary conditions or declining market liquidity could reduce investor appetite for emerging asset classes. Digital asset markets have historically been sensitive to shifts in global liquidity and risk sentiment. Under these conditions, infrastructure developments such as the XRP ledger's expansion into areas like trade finance or logistics might continue technically, but adoption could progress more slowly than current market narratives suggest. None of these scenarios is guaranteed. Each depends on regulatory decisions, capital flows, and technological adoption that will unfold over time. When markets move quickly, it's easy to get distracted by headlines. Social media tends to amplify price moves, rumors, and short-term narratives. But the signals that actually shape medium-term market direction usually come from a smaller set of indicators tied to liquidity, macro conditions, and positioning. One of the first things I watch is the US dollar index. The dollar remains the world's primary reserve currency. and its strength often reflects global demand for liquidity and safety. When the dollar strengthens rapidly, risk assets, including digital assets, have historically faced pressure. When the dollar stabilizes or weakens, capital tends to rotate back toward higher risk sectors. The second indicator is U.S. government bond yields, particularly the United States 10-year Treasury yield. Treasury yields influence the global cost of capital. If yields rise quickly, borrowing becomes more expensive, and risk assets often struggle to attract new investment. If yields stabilize or decline, financial conditions loosen, and markets typically respond with increased risk-taking. Inflation data is another variable worth monitoring. Reports such as the Consumer Price Index and the Personal Consumption Expenditures Price Index influence expectations around interest rate policy. These reports shape how the Federal Reserve System approaches monetary policy decisions. Within the digital asset market itself, I also watch liquidity indicators, trading volume, derivatives, open interest, and funding rates. These metrics reveal how aggressively traders are positioning in either direction. When leverage rises too quickly, markets often become vulnerable to sharp corrections. Finally, positioning across regulated investment products can offer insight into institutional sentiment. Flows into exchange-traded products, such as the Bitwise XRP ETF, may indicate whether professional investors are gradually increasing exposure or remaining cautious. None of these indicators provide certainty, but together, they help build a framework for understanding whether market conditions are tightening, stabilizing, or expanding. And in markets, the direction of liquidity often matters more than the headlines of the day. If you step back from the daily noise, what we're seeing right now looks less like a sudden revolution and more like a slow shift in financial infrastructure. A crypto firm gaining limited access to Federal Reserve payment rails. New exchange-traded products quietly attracting capital. Blockchain settlement systems being tested in industries like logistics and trade finance. None of this guarantees a specific market outcome. Financial markets rarely move in straight lines, and developments that look significant today often take years to fully play out. Regulation can accelerate adoption, but it can also slow it. Liquidity can expand, but it can also tighten quickly. That's why the most important discipline in markets isn't prediction. It's risk management. Pay attention to liquidity. Watch the macro indicators and avoid letting short-term narratives replace long-term thinking. This isn't investment advice. It's simply how I'm reading the market right now.